Good morning, all. Let's start with a morning call. The biggest event this past week was the surprise US credit rating downgraded by the Fitch, which has led the sell-off in the global market and the bond markets. Indian market were also down 1% on week-on-week basis, while the FII saw the net selling of nearly $0.3 billion on week-on-week basis. India CPI for the month of July is expected to rise nearly 6.5 to 7 odd percent, primarily led by the sharp surge in the food inflation, while the RBI is expected to be on the pause in the August policy. While the inflationary pressure are uncomfortably higher than what the street earlier expectation was. This, along with the global development of Bank of Japan making YCC ban more flexible, alarming downgrade of US economy owing to surging debt, and the global and Indian valuation risk to further fall in the Indian equity. If you see on valuation front, currently the Nifty is trading at one year forward price earning of nearly 18.8 times. Since the reporting quarterly numbers has season has begun, India has seen the earning upgrade of nearly 1 odd percent. Suggests the further earning upgrades are likely as a proportion of the stock with the positive management guidance scores remains at historically high. Coming to few quarterly numbers which has reported in last 1 2 days, starting with the M&M numbers, reported a first quarter beat on sales and EBITDA front, which has exceeded the estimate by 3% and 14%. The farm segment operating profit and EBIT margin has surprised by 14% and 40 bips versus estimate in context of the favorable commodity prices and efforts on mix and costing. Specific to the M&M's recent 4.2 billion rupees investment in RBL Bank, management clarified that this is an investment to enable it to work closely with the RBL Bank management to explore the synergy between the Mahindra Group and the RBL Bank. We think that the M&M investment in RBL may be the topic of debate today, but it is relatively very small factor in the company's long-term growth story. We find the investment opportunity in its core business, that is auto plus farm, at an attractive valuation, while the demand visibility is stronger than peer and the margin levers are favorable. Risk reward is skewed to the upside at current valuation. Both auto and tractor business imply a cheaper valuation than peers relative to the growth opportunity. We maintain our buy rating. Other big number, SBI first quarter number in name shocker and a poor quality beat, while the overall ROA remained unchanged quarter on quarter basis. Sorry, the NIM saw a sharp decline of 27 bips quarter on quarter, an outliner amongst the bank that have reported the numbers so far. On growth front, SBI remained the true sector proxy with the loan and deposits which are growing in line with the system growth, that is 15% YOY and 12% YOY respectively. Overall, a weak set of number, primarily on account of sharp decline in the NIM, even though the overall profitability still remains much higher than the bank target of an ROA. With the improved ROA and ROA profile, we should aid better compounding, while the clarity on the extension or change in the chairman will be the key to track from here. The buy rating stays on the stock. Coming to Bank of Baroda numbers, again, the big miss on the NIM front. PAT was 19% below what the street was estimating. ROA was down nearly 1.1% versus 1.3% seen in last quarter. The NIM challenges remain. Expect funding cost to rise further. Bank of Baroda needs to increase the pass-through, particularly on the corporate loans. We prefer large private bank over Bank of Baroda post results, such as Axis Bank, has given the Axis Bank has ability to successfully balance growth versus NIM, which will lead to meaningful valuation upside for the Axis Bank in our view. Given the long-term measure undertaken to improve the liability franchisee and portfolio granularity, we now expect ROA and ROE of 1.7% and 17.6% for FY25 for Axis Bank. PB Fintech is also one of the stock which we like as an actionable, as the policy bazaar is the one that has delivered faster than expected revenue growth while also turning profitable on adjusted EBITDA basis as guided. While we expect the insurance premium loan disbursal to grow by nearly 40 and 56% YOY as company is continues to grow to twice and thrice the industry growth rate. We now forecast the company to deliver the insurance premium, loan disbursal, and revenue CAGR of 32%, 29%, and 32% over FY23 to 26 period, with the adjusted EBITDA margin expected to reach by 10% in FY26. Cipla stock will be in focus for today as well as for and we expect the policy repo rate unchanged at 6.5% with the continuous hawkish guidance and reiterate the 4% headline inflation targets. Globally, US inflation data week, as said, will likely to confirm the continued disinflation trend, the continued disinflation and the labor market weakness beginning in Q4 should convince that the Fed should hold rate going ahead. That's it. We'll stop here and hand over for further update. Thank you.
Very good morning, friends. This is Rahul Sharma this side from the Technical and Derivatives Research. It was a subdued week for the Nifty 500 as Nifty took support at the 19,300 mark for the third consecutive time in the last 4 to 5 weeks. And finally, we saw Nifty managing to close above the 19,500 mark. Now, looking at how the cues from US are placed, we have the Dow Jones index, which had broken out a few weeks back around the 34,700 mark, and post that we had seen a good rally in the Dow Jones. Now we are seeing a pullback happening over there where multiple supports are placed at 34,700, which means that for this week, the downside may be limited for the US markets, which is only around 300 points. May happen, may not happen. Also, Friday, although US markets were down, but the S&P VIX did not create a new high. So the market is not fearful as far as the US indices are concerned. And secondly, the VIX VIX for US has a strong resistance at 16.5. So it is probably near the upper end of the range as far as the volatility index is concerned. In fact, India, which also formed a bearish inverted hammer on the weekly charts in spite of the correction seen in the last week, which means that probably the mini correction from around 20,000 odd that we are witnessing is almost over. Now, the participants, as far as the institutional participation is concerned, it was FIs who had created aggressive shorts on Thursday. So on Thursday, we had around 40,000 contracts short on the index futures. But on Friday, they were again covering their shorts as the net open positions as of Friday closing are around 25,595 contracts on the index futures. Retail was the one to go long on the market on Thursday's dip when Nifty touched 19,300. And they literally went by the adage of buy the dip. So the net long contracts by retail on Thursday was around 60,607 contracts, way higher than what FIs had shorted. Clearly, the top performing sectors in Nifty for the week were IT, a mix of primarily short covering and a bit of non-built-up scene. Public sector enterprises did very well, led by the likes of NTPC, and pharma, which did excellently well on the back of Cipla, on the back of Lupin and the likes. Selling was seen in banks, NBFCs, and auto stocks. Week on week, the combined open interest has remained flattish for Nifty and Bank Nifty. So no real positions were added, while mid-cap Nifty saw an addition of around 26.5% on the long side. The week on week put call ratio has improved the most for Fin Nifty, which is now settled to 0.82, followed by Nifty, which is at 1.04, both of them up by 41% and 27% respectively. So what this shows is there is put writing which is back into the system in the previous week. So in spite of Nifty testing 19,300, A, there is short covering by FIs, and B, there is no real spike in the volatility index. Now, as far as stocks are concerned, actionable ideas are concerned for this week, the two defensive names which come from the FMCG consumption space are Britannia and Tata Consumer. Britannia has shown signs of bottoming out near the 4750 mark, and as there is a bullish divergence, and also there is put writing seen in the counter. So we may see a bounce back in Britannia in this week. Tata Consumer also looks pretty solid. It is consolidating, forming a bullish golden flag pattern on the daily charts. It has taken support near its 50-day EMA, and it may see a bounce back from these levels. In fact, a breakout may happen once we cross the 860, 865 resistance area. On the momentum stocks or thrust stocks, so TCS is one stock that we like. In fact, IT was the star performer in the previous week, and we feel that TCS should aim for its next target of 35.75. We have initiated a high conviction delivery idea in TCS, the target 2 of which should get achieved in this round of up move. Secondly, Adani Ports has given the highest weekly close since the 20th of January, which means that we should see some fireworks in Adani Ports. 780 is a key level to watch. Once 780 is crossed, we can expect a breakout in the same, like a breakout on the daily charts. On the weekly charts, the breakout has already happened as we've closed the week at almost like a 7-month high. Secondly, thirdly, Divis Labs looks good. Pharma has been doing well, and Divis Labs can witness a fresh breakout about 37.95. It has closed at 37.45. So once this breakout happens, it may head towards the 4,000 mark on the upside. So there are three names which look good on the momentum side, which is TCS, Adani Ports, and Divis Labs. As far as Nifty is concerned, the weekly view is that we can expect the correction to end once we cross the twin resistances of 19,605 and 19,705. So 19,605 is a Fibonacci retracement, 19,705 is a gap on the daily charts. Both of them, if crossed, we should see the Nifty sailing towards the 20,000 mark from here, and 19,295 becomes like an all-important support and a stop loss for long positions. So bearish zone is expected only if we break 19,295 in this week, and as long as we remain above the 20 DMA, which is 19,542, one can expect bulls to dominate the long side. As far as the macro view is concerned, 19,300 has turned out to be a strong demand zone in the entire July, and dips would be ideal buying opportunities. However, we advise to keep some cash allocation available in case 19,000 does get tested, which is the previous breakout point. And if it does happen, that could be a good buying opportunity on the dip. Overall, the macro view is positive for 21,000 Nifty by the end of this year. Now, one interesting setup that I have spotted over the weekend is in ICICI Bank. Now, this is more of a macro view, not like a trading view, so take it accordingly. So, if you see the monthly charts of ICICI Bank, there is a triple top divergence. So, the first top was formed in early 2022. Then another top was formed around the April mark, and now after the results, a top was formed around the 1,000 mark. So in each of these tops, clearly the momentum has gone down for the stock, which means that it is advisable to book profits in ICICI Bank and probably shift to some of the other names like maybe do sector rotation as well, because banks are expected to be slightly under pressure. It may not flare up the way we've seen banks doing well over the last few months. So from a leadership perspective, when the sector leader, so ICICI Bank has been like a sector leader, if the sector leader is showing signs of exhaustion, it could mean that in the next 3 to 4 months, we could see banks taking a backseat, especially private banks. So as of now, there is a technical indicator which is suggesting that it is advisable to take money off the table. The stock is trading at live highs, so in delivery, one can look to book profits. Alternatively, sectors which are looking good, public sector enterprises is one, should continue to do well. Metals is another sector which should continue to do well, and we could very well see the traction back and forth happening across sectors. But IT clearly is a value buy at these prices. So these are three sectors where one can look to switch. So I would say that banking versus IT is one switch that we can advise to clients. From a 6-month perspective, clearly banks have done their job. It is IT which can do well from these levels, and we could very well see what we had probably in the last, like during COVID, it was IT which was doing well. Then banks took a backseat, and post that we saw a rally happening in the bank. So I think this rally probably is close to maturity, and one can look to make this switch in the portfolio as well. So that's it from my side. I'll hand over the call for further updates. Thanks.
Thank you, Rahul. Good morning, all. Jai this side for the currency and commodity update. The dollar index as well as the US 10-year bond yields cooled off from the higher levels after the non-farm payroll failed to provide a straightforward narrative for the investors. The US non-farm payroll increased by 187,000 jobs last month against the expectation of a gain of 2 lakh jobs. The wage growth is higher than it was before March 2020 at 4.4% on year-on-year basis. Dollar index fell by 0.5% and closed around 102 levels. While if you look at the weekly chart, it managed to form a green candle for the third consecutive week. As of now, the CME Fed Watch tool indicates around 24% probability of a 25 basis point rate hike by this year end. While for the September month, there is only 12% possibility of a 25 basis point rate hike. Now today, couple of FOMC member comments is there, while this week is full of data wherein the CPI inflation number is there on Thursday, jobless claim is there on Thursday, as well as the consumer sentiment is there on Friday. In India, RBI monetary policy is also there on Thursday. So this week will have a major impact because of the data, and the USD may show some bit of volatile move in the later half of the week. Now, looking at the overall structure, the dollar index is expected to trade in the range of 101.40 to 103 levels. As of now, structure is still on the positive side, and we can see buying interest emerging from the lower levels. USD INR future continued the positive momentum for yet another day and ended the week around 82.90 levels. Currently, it is hovering around its crucial hurdle of 83.10 zone, which acted as a major reversal point in last 10 months. Also, we witnessed that RBI has been very active defending 83 mark from last few months, and thus a selling pressure from the higher levels cannot be ruled out. Now, in such a scenario, it's a preemptive trade, and thus traders can buy the 82.75 put option of the monthly expiry, that is 29th August, around 20-22 paisa, with the stop loss of 10 paisa, and on the upside we can see the put moving towards 40 to 50 paisa. Please make sure that this is just a preemptive trade, and this is not a trend reversal in the USD INR, and thus it's better to trade with the put options rather than taking the call writing or future selling positions. On the commodity side, the precious metals ended Friday's day on a flattish note. Looking at the overall scenario, gold future is expected to trade in the range of 59,100 to 60,000, for next couple of days with a positive bias, and the dips can be bought into. While the silver future is good only on a sustainable move above 73,000 levels, if it manages to hold above 73,000, then it may bounce up to around 74,500 to 75,000 levels in this week itself. On the downside, support for silver future is placed at 71,500 levels. Crude oil rallied by 1.5% on Friday and closed above 6,850 levels. It is giving a breakout on the daily chart and moving out of its trading range. Well, if we look at the Brent structure, it is yet to give a breakout, and thus the structure is a bit confusing because on MCX it is giving a breakout while Brent is moving near the hurdle levels. Overall, after the 6 weeks of consecutive rally, the risk reward is not so favorable at current levels, and thus, if any dip is there up to around 6,700, 6,750 levels, then traders can look for a buying opportunity for a target of 6,950 levels. So that's it from the currency and commodity side. Now we are open for Q&A.